Well, hello, everybody, and welcome to the program. My name is John Bowens with Equity Trust Company, broadcasting here in the Equity Trust virtual classroom. Joining me in the classroom today is Bruce Roberts, who is the founder and CEO of Carofin. And Carofin is a company that specializes in working with direct private investments. And when we talk about direct private investments, what we're talking about is investing in privately held companies. So rather than investing in the traditional financial markets and the public markets, we're going to spend today talking about investing in the private markets. And so Bruce Roberts and his firm Carofin has prepared an agenda where they're going to talk about how you could potentially look at private direct investments. That is, again, investing in privately held companies. And he'll speak to both investing as an equity investor as well as investing as a debt investor. Now, the reason why we have Bruce and Carofin on today's call is, first, let me mention that Bruce Roberts has over 35 years of experience in investment banking and financial services. He started Carofin in 1996, and since then, they've raised over $1.2 billion for small and medium-sized companies through over 200 securities offerings. So what that means is that Bruce and his team of analysts have actually examined, and they have a scientific approach that you're going to hear about. They've examined over 200 privately held companies. So we're really excited to have Bruce on today's call. He's going to be taking the lead on the agenda in just a moment. I'll also mention that Bruce, prior to his 35 years plus in experience in financial services and investment banking, he served as an officer in the United States Navy as a U.S. Navy SEAL. So we also want to thank Bruce for coming on today's call and serving our country. So with that being said, Bruce, can you jump on the call, share a little bit about who you are, share a little bit about Carofin, of course, and your philosophy, and then, of course, go ahead and jump right into the agenda and what our class is going to learn today.
Sure. Great, John. And listen, it's really a pleasure to be here. We really appreciate the opportunity to work with Equity Trust in reaching your client base and talk about this subject, which is near and dear to us. We really are specialists in this field in the area of private finance and financing small to medium-sized companies across the country. In the way that the financial services market has evolved and the way that investment banking in particular has evolved, things tend to consolidate, transactions tend to get bigger. And as a result, we're actually a fairly unusual firm in the world of FINRA, which is our regulatory authority and generally describes broker dealers around the country. So we've been doing this since 1995, and you learn a lot in that process. And so in recent years, we've been writing this down and looking for continuity, looking for patterns, frameworks, ways that we could basically help individual investors look at what is really a broad universe of opportunities, and then find a consistent process that allows them to find those investments which are most appropriate to their situation. So, for today's presentation, we'll try to make sure everybody gets a real solid sense of what a direct private investment would be, and secondly, where are the opportunities for individual investors? The fact that you would be an Equity Trust client really puts you in an extraordinarily good position to take advantage of the direct private investment market and do it in the most tax efficient way, because obviously you're deferring any gains on that, or for that matter, any recognition of ordinary income as you receive ordinary income. We'll talk a bit about how we evaluate direct private investments and offer you a way to look at any transaction, any offering, and begin to contrast and compare. That probably is one of the bigger challenges for the individual investor who's in this market, is you tend to find out about these deals traditionally by word of mouth. And you hear the story, it sounds good to you, but you don't have any point of reference for how does this transaction look relative to another transaction. And I think one of the things that we really encourage is get yourself into a flow of offerings that, again, can allow you to contrast and compare, and probably as a starting point, first evaluate what you're trying to accomplish with this part of your investment portfolio. And then, we will speak a bit towards the end about the sort of things we do to make ourselves a resource to investors who are participating in this market. By the way, though it may be less familiar to you, it's an enormous, enormous market. It's over $2 trillion of securities issuance a year in the United States. That actually makes it larger than the public markets in terms of annual transactions. So it's private, so that makes it discreet, and you may know less about it. It is less documented in terms of educational resources. And again, that's something we're trying to tackle at Carofin to provide investors, not just in our transactions, but in any private transaction. I think this is sort of universally beneficial. So look forward to the presentation with you, John.
Okay, Bruce, I do have one question that I want to ask, and that is, you had mentioned that the private markets have surpassed the public markets. Could you expand a little bit for our viewers on why that may be?
Sure. Like any market, there's two sides to the market. There's demand and there's supply. Supply in this case would be borrowers. I won't put a lot of energy or talk into that, other than to say commercial banks as a source of capital are not as available to operating companies as they used to be. The demand side of it, which in this case I'll attribute to investors, there's many facets of it. One, if you're looking at debt instruments, you can look at the nominal yields that are available today. We're in a 1% or lower interest rate environment when you're talking about U.S. Treasuries, and that's a rate that, to the extent that someone needs current income personally for one reason or another, is just not sustaining. And to the extent you're looking at locking those funds up in the long term, then you're sticking yourself with a very low interest rate environment, the lowest certainly in generations, and you would be better off. You're looking for yield. You want a higher return. You're arguably probably taking risks that suggest you should get a higher return. The other would be market volatility. We live in a world where international events have such a significant impact on domestic markets, and obviously 2020 with the pandemic is a pretty classic example of that, where it became a global event. Businesses are interconnected globally. Stock prices move up and down because of global events, and folks are just, how could you possibly understand that and consistently predict where the markets are going to go? Obviously, there's an enormous industry of professionals who do that for a living all day, every day. And here we're talking about investments being made predominantly by individuals. So I think those two factors, as much as anything, is, and it's going to correlate, or it's going to refer to something we talk about later in the presentation. Absolute return, non-correlation are two of the primary elements that a direct private investment can give you. In the case of absolute return, it's a return based on the performance of the issuer. In the case of non-correlation, it simply means the return is not impacted by the volatility of markets. And so in this case, the absolute return should be higher because it's a private investment and some of the risks inherent to a private investment. And non-correlation is because, again, it's a private security that isn't going to trade in value up and down with the public markets.
So as the class can already start to tell, there can be an incredible amount of opportunity that can exist investing in private securities. And particularly when we talk about investing with a self-directed IRA, self-directed solo 401k, health savings account, covered education savings account, or really any other type of tax-exempt savings environment that we have to offer, particularly here at Equity Trust Company. So that's why Bruce and Carofin and Equity Trust got together to put on this webinar, because we have a lot of specialized expertise here at Equity Trust around self-directed IRAs and self-directed solo 401ks in creating tax-deferred and tax-free cash flows. And Bruce and Carofin has the ability to speak specifically about that private direct investment opportunity. All that being said, as we're going to be talking about throughout today's program, there's an incredible amount of due diligence, of course, that needs to be put into these types of selections and investments. And we encourage everyone to perform their own due diligence prior to engaging in transactions. Now, I know you likely already are developing questions. So what I want to make sure that we do is offer an opportunity for everybody on today's call to ask their questions and get those questions answered promptly. So as I mentioned, Equity Trust Company is a directed IRA custodian, and Carofin, Bruce has already introduced them. They are a FINRA registered company, and Bruce at the very end will talk a little bit more to those specifics. Important to know that Equity Trust is a directed IRA custodian. We're here to provide education and information. What we don't do here at Equity Trust is provide tax, legal, or financial advice, nor do we endorse any particular type of securities offering or other investment opportunity. All of that being said, here's what I want everybody to do at this point in the call. If you have questions specifically about direct private investments for Bruce and his team, I want you to open up an email and put in investorrelations@carofin.com. So everybody open up an email, investorrelations@carofin.com. And so what we're going to do is I'm going to have you put in all of your questions and all of your feedback in that email, and then you can email that off to Bruce and his team so that they can respond promptly. If you have questions specifically about a self-directed IRA, a self-directed solo 401k, a Roth IRA, a Roth conversion, what's the process look like to invest in a private direct investment? What does that mean from an equity trust perspective? I want you to provide those questions and that feedback in an email directly to me, j.bowens@trustetc.com, and we will get those questions answered for you promptly. Now, what I'd like everybody to do in the email is send to us, what were you looking to get out of today's program? All right, so what were you looking to get out of today's program? Put that at the top of the email. And then all of your questions that you formulate throughout the program, because I know you're going to have questions, put those in the email. And then at the very end of today's webinar, we're going to have you hit send. And the questions for Bruce and his team will go to him. And the questions pertaining to self-directed IRAs will come directly to me so we can answer those for you promptly. All right, so with that being said, I'm going to hand it over to Bruce now, and he will be handling a majority of the content for today. Again, Bruce, thanks for being with us. Really appreciate you being able to provide all of the information and education around direct private investments. So I'll hand the mic over to you now.
Okay. Great. Thanks, John. This slide has only taken about 25 years to develop. What I mean by that, meaningful investments, vital capital. One of the things we'll talk about later in the presentation, but I want to emphasize up front, is the direct private investment world allows you to direct your capital to those enterprises that are meaningful to you. It could be meaningful because what that enterprise is engaged in. It could be meaningful because the individuals behind that enterprise, you know personally, and you want to support them, you trust them, you have confidence in their ability. It could certainly be meaningful because it achieves, it supports a local economy and is creating jobs in your community or in your state. So, you know, we've grabbed meaningful investments because the flexibility you get with direct private investments. And I think it's important to note the reason that the self-directed IRA that Equity Trust offers is so important is because your standard IRA will not give you the flexibility of self-directing your investment. We've worked with Equity Trust for many years, and we can tell you over the years, we're seeing a growing trend of investors transferring capital from a traditional IRA to a self-directed IRA, maintaining their tax-deferred status, but gaining the ability to, again, self-direct their capital into private investments and those that are meaningful. Vital capital, really, it's vital from the perspective of the party that's receiving that capital. I spoke earlier about really the challenges that traditional operating companies have, local businesses, in getting bank financing. They're capital constrained. And even companies that are finding great success, you know, companies tend to go through two cycles where they're capital stressed. On the front end, they're a startup company and they don't have enough capital. They're looking for capital to meet operating expenses. They're not profitable. and they need capital to really prove out the concept and build up the business to the point that it's generating enough profit margin to pay for its expenses. But even if a company is in a highly successful mode and now their sales are growing dramatically, often as not, they're starved for working capital. Traditionally, these loans would come from a line of credit from a bank that may well not be available. And so a lot of the financing that we do, particularly shorter term financing of, let's say, 1 to 3 years for debt financing, is used to meet a working capital need to buy inventory, so they can keep up with their sales. So meaningful investments, vital capital is we think sort of fundamental to the investments we bring to investments. Meaningful to you, the investor, is vital to the recipient of that capital, the issuer. So let's move on through the presentation and direct private investing. There's two things that drive a wide amount of variety in this market. One is the participants in the market. So in this case, we're talking to individual investors, but you should know that the largest ultra high net worth investors, family offices, this is also very much a concentration area for them. Investing through funds, which is sort of the alternative to a direct investment, is to invest through a managed program like a fund. That the direct private investment offers some unique attributes that you just can't get through a fund. And some funds, because of the way they've gone, so in some cases they've grown out of their niche, and may not be able to, they're scrambling to achieve the returns to attract more capital to have the next fund. All of this is driving a lot of investors to increasingly consider making direct investments themselves. But as we'll talk about a little bit later, like the economist said, there's no free lunch. You really need to do your research sort of broadly on how this market works and how companies work. And then also, probably even before that, you need to look at your own circumstances. So I'm going to take a second, John, even though there's not a slide to speak to it, because I think it's really fundamental to how we approach a conversation with an investor. There's two concepts from a legal perspective and then from a practical perspective. On a legal perspective, the private placements we offer are available to what are called accredited investors. An accredited investor, simply put, is if you're an individual investor, you've made $200,000 in the last 2 years, and you would expect to make $200,000 in the current year, gross income, or you have $1 million net worth. If you're a married couple participating, that number is actually $300,000, but it's also still $1 million net worth. It's $1 million net worth, not including the value of your primary residence, importantly. So that's the definition of an accredited investor. So the first question you ask yourself is, am I accredited? Now, the crowdfunding market, which no doubt many people on the call here have heard about, is available to investors that are not accredited. And in fact, we're exploring dual offerings where we can entertain investments from non-accredited. So I would hope for those persons who are listening to this who happen to not be accredited, we'd love to hear from you as well, because it would give us a sense of the demand, and if we can't accommodate that, we believe the securities laws will allow us to do so through a partnership with a firm that's better suited to doing that. The fundamentals of the deal will be the same. We treat all investors the same. It doesn't really matter how large your investment is through us. Everyone is treated the same. So there's accreditation. The second issue is suitability. It's very important that the direct private investment is part of what you call alternative investments. Generally speaking, it should be a minority of your portfolio. The bulk of your investable capital would typically be in investments that have more liquidity, i.e. you can sell them before they mature, and also which arguably have a lower risk profile. So for example, if we sell a promissory note for a private company that say they grow corn, they're a farmer, that's going to be a lot higher risk than a U.S. Treasury. Even given the state of our government these days, the U.S. Treasury risk is still a much lower risk than virtually any private company. So balancing out the risk in your portfolio so that you're not overexposed to the sort of investments we're going to talk to is very important. And so suitability is about can I take the risk? Can I afford to potentially take a loss? Because there's no free lunch. Where you get higher return, you should assume you're taking higher risk. And if in any offering you look at someone's not giving you a balanced view where you're able to appreciate the risk, then that's a red flag that you should really take a step back and ask more pointed questions. That, again, if there's any hesitancy to answer those questions, then that should be a concern. Never, this may sound odd from someone who sells these kind of securities, but you should never hesitate to pass on a deal, to walk away from it. There's a lot of fish in this sea. There's over 28 million small companies in this country that most of them need capital. And if you can get yourself in a situation where you're seeing a consistent deal flow, and that is one of the things that we believe we bring to investors, is we're continually bringing transactions. So you can pick and choose the ones that fit. But if you can find other sources for those deals, better to not do a bad deal than sort of feel rushed into one and find out that it was not the right decision. Accreditation and suitability are important. I guess I'll say a third thing: diversity. You never want to have too much of an exposure in any one transaction. So within the part of your portfolio that you might allocate to direct private investing, you want to take a series of smaller investments that are consistent with what you're trying to achieve. That way, if you do have a challenged investment, it's not going to destroy a significant part of your portfolio. And you would do that in your public investments as well. You'd always try to achieve diversity. So we actually invite smaller investments. The smallest investment that we would accept in our transactions is $10,000. And so to the extent that you've got $100,000 in a self-directed IRA, you've got an opportunity to build a nice level of diversity. So to the PowerPoint slide, if you would go back one, if you don't mind, I'll try to speak to it. A direct private investment is an investment in a single entity, a single operating company, a single business. Two, it's private. And what private means is simply it's not publicly registered with the Securities Exchange Commission. Now, there are notifications that are formally made to the SEC about every private placement that happens, but the registration requirements of a fully public company, audited financial statements and things of that nature, are not applicable to a private placement. But there is a very extensive set of regulations around private placements that we adhere to. But fundamentally, it's discrete, and it is more of an open field in terms of what disclosures are mandated. The market size, as I said, is enormous. It's in the trillions. And you're looking for a subset of it that would accommodate, individual investment by yourself. Okay, now we can look at the next slide. Importantly, a private offering is a manner of offering, and it's simply, is it private or is it public? In this case, we're talking about private. You can sell the same form of security privately that you can sell publicly. So equity, stock, such as the New York Stock Exchange, such as a NASDAQ listed stock, fundamentally is the same type of security as a sort of equity security you would buy through a private placement. The difference is it's offered privately and it's not listed on a public exchange. That not being listed on a public exchange has ramifications as it relates to your ability to sell the security before it's maturing. A private security is illiquid by nature, meaning it's a buy and hold security. You would expect to hold that if it's debt until it matures, if it's equity until the company is either sold, or in some rare cases, it could still go public. Debt is indebtedness. It's a loan, often shows up in the form of a promissory note. So you're the owner of a promissory note that has fixed repayment schedule, both in terms of when it matures or how it amortizes, how the principal is paid back, or what interest rate is paid on the debt at the time. Now, what you're seeing when you look at this slide is there's equity, but equity can be preferred equity, or equity can be common equity. Preferred equity is, as the name would suggest, has a preferred liquidation preference, meaning if the company is sold, those preferred investors will be paid before common investors. Debt is either senior secured, senior unsecured, or subordinated. Senior secured has collateral behind it, very much like your home mortgage. When you take out a mortgage on your house, you're offering the bank your home as collateral. And if for some reason you can't repay the loan, then they can turn around and sell your home and they can get their principal back. No different for you as an investor in senior secured loan to an operating company. Some form of collateral is being offered up. If it's short-term debt, it's typically inventory, accounts receivable, things of that nature. If it's longer-term debt, it could be equipment and things of that nature. Senior unsecured is still a more senior security, but it has no collateral. And subordinated, as the name would suggest, is actually subordinated. What also goes with these is you would expect to get the higher rate of return for the riskier security. So if the subordinated debt is of higher risk, it should have a higher return. In today's market, that's going to be somewhere north of 10% return. Senior secured, again, for these kind of investments, will still be a relatively high return. It'll be a high single digit, 8, 9%, and certainly could be in the 10, 12, 11%, or 10, 11, 12%. When you're looking at equity, you're really asking yourself, what's the likelihood that the value of the business will grow, the equity value of the business? When you're looking at debt, you're really looking at what's the ability of the company to repay me, what's their cash flow. So they're very different analyses. That's, I guess, a subject for another webinar, John. But again, equity, ask yourself, is this becoming a more valuable company? Is their customer base growing? Is there something about their product that has patents or trademarks or other intellectual property that's gaining in value because of where it fits in the marketplace? If it's debt, you're not getting a share of the profits. You're really getting back that interest rate. So you really need to know that it's going to have the ability to repay you. By their nature, equity should pay you a higher return than debt because it's a riskier security.
Either way, the takeaway, folks, from this slide is your IRA can invest as both an equity partner and a debt partner. And folks would want to work one-on-one with their CPAs, work one-on-one with their firm that they're actually working through that investment security offering with, in order to determine what is the financial scope of the transaction and does it make sense for their IRA portfolio. All righty, so we got the next slide up here for you, Bruce.
Yeah, so what's the opportunity? Greater investment return potential. I want to underline potential because, again, where there's higher return, you should assume you're taking higher risk. If I contrast this to the public markets, these bullet points are really meant to say, what does the public market offer you? And then by extension, why would the private market potentially be a higher return? It's quite interesting. If you go back about 15 years ago, maybe 20, there were about 7,500 public stocks that were listed. The number right now is about half that. I believe we're under 3,000 public stocks, and that's largely a function of a consolidation among businesses. So one of the reasons you're looking at price earnings multiples right now, and they're at such relatively lofty levels. I mean, historically, I'm 35 years in the business. So when I started, people assumed that a price earnings multiple in a public index is going to be on the order of 11, 12, maybe 13 times. And it's just not at all uncommon right now, particularly in your tech stocks, to find that you're trading at 30 times. And then you can look at some extreme examples for some of the deeper tech stocks that are significantly beyond that. But the point is, it's classic supply and demand. For those who are investing in the public markets, you've got a lot of money chasing a shrinking number of investment opportunities. There's about 8,000 mutual funds. So there are actually significantly more mutual funds than there are publicly listed stocks today. So that should give you some sense of why is that market so competitive. By extension, every private offering is a discrete offering where there tends to be much less competition among investors for that investment opportunity, and the return reflects it. So, for example, in the public debt markets, we're having this conversation in mid-January of 2021. We're essentially in a 1% interest rate environment, or less, if you look at U.S. Treasuries or you look at money markets. So let's just say a one-year Treasury today is well under 1%. A one-year private investment that we would offer in this market would be, from our firm, in the order of 10 to 12%. That would be the range. And if it was a riskier, we might actually engineer something a bit higher return than that. That return will not change from the private market significantly if the public market's backed up and you found that a 1-year security was a 4% security. It's not like that 10% lower threshold is going to go to 14. It's somewhat inelastic, if you will. But today, the delta, the difference between where a public market is and where the private markets are, it's probably as wide as it will be in our lifetimes. And so it makes it a particularly interesting time to grab that incremental return. And that is solely a function of investor competition, supply and demand. A lot of investors of all descriptions needing a fixed income investment and then reaching in, and then you find that the delta, or really the alpha that you're picking up in the private investment, is much greater. Another reason why the public markets trade at a higher price, or as we say in the business, it's a richer price, is available information. As public companies, they're required to make certain disclosures. And so you've got ubiquitous information about public companies and, thousands, legions of investment analysts pouring over that, looking for value. In the private market, every transaction is a discrete transaction. Now you have to be careful. You have to demand that you get certain minimal financial disclosure. And again, there's a whole other conversation about financial analysis and due diligence. But the fact that it's private, the fact that it's not publicly available, suggests you should get a return than the public markets would offer, just because information is more readily available. And then importantly, as I've mentioned a couple of times, liquidity. Private investments are buy and hold securities. Public markets would have a market maker, broker dealer, that a trading up organization that's making a market in that security. And that liquidity suggests that, the illiquidity, I should say, of a private market suggests you should get a higher return because you're taking the risk of holding that security through different cycles. You don't have the luxury of selling the security if you just don't like the market. So you get paid for that. You should be paid for that in a higher return. So one opportunity, one element of the direct private investment is the returns. I think we can go to the next slide. We've got another element of it. I mentioned this at the beginning. I won't belabor the point here, but because you are making the call yourself, you're self-directing, if you will, your capital to a specific enterprise. You can determine, what you're trying to accomplish with your funds that might go above and beyond just a simple investment return. You want to accomplish something with your money. It's meaningful to you. We can go to the next slide. And this one's going to sound a little wonky, but it is quite important. Absolute returns, less correlation. By absolute returns, we simply mean that the return on the investment is a function of the issuer predominantly. You can invest in a company that in the public markets on balance is doing well, but if you happen to invest in that company in early 2009, the chances are you're going to take a loss on that security because the market overall was declining. You might argue, and actually this is a kind of a confusing time for the public markets because so much of the market gains in the indexes are actually being driven by a small number of technology stocks. If you look across the index broadly, they all haven't appreciated equally. But still, overall, the public markets, that rising tide in a rising market or that falling tide in a falling market has a tendency to either pull all stocks up or push all stocks down. In the private market, much, much less so. And it's not that private companies aren't affected by commodities markets and things of that nature, but the public stock markets, the public bond markets really have no impact, because if you buy a promissory note, it has a 12% coupon on it, interest rate on it, the company's obliged to pay 12%. And it really doesn't matter if the public interest rates are going up or going down. If you're buying equity in a promising technology company, that company is going to prosper or not based on how well their business performs. Now, clearly, the public markets have an impact on exit values for private companies, but if it's the right company with a vital service, a vital product, there's a merger and acquisition market in almost any environment that would allow you to sell that company. And I guess global volatility. And, we are, of course, an increasingly global economy. And the global financial markets certainly have an impact on the U.S. public markets. Again, much less so in the private markets, where you're investing in the apps. There's less correlation between your private investment and that global or even domestic market volatility. So again, absolute return means simply your return is tied to the performance of the company you're invested in predominantly. Less correlation means markets go up and markets go down, but you should expect that your private investment really is going to track along the lines of what you bought, what you invested in, that investment theme initially. Okay, this is going to take us in a little bit different direction. And the purpose of this slide is to give each of the investors a basic framework with which to look at a broad variety of deals. As we've said in this call, you've got debt, you've got equity. Within debt, you've got senior debt, you've got subordinated debt. Within equity, you've got preferred stock, you've got common stock. But that's just talking about the security. If we talk about the issuers, you've got technology companies that might be developing an enhancement to either hardware or software development. You've got traditional agriculture companies. Even in agriculture, you've got farming operations, you've got food processing operations, you've got retailers, grocery stores, et cetera. So distribution companies, trucking companies, think about the economy. That's the variety of issuer that potentially could be an issuer in the private market. So the question is, how do you begin to make sense of it all? Because the variety can be a bit bewildering. So what we're offering here are what we call 5 elements of private investing. So it's five categories of consideration, if you will, that we think will get you well past first base in terms of understanding what's in front of you, and very importantly, making a quick decision as to whether this is a suitable investment for you, depending on what you're trying to achieve in your portfolio, with this part of your portfolio. So, and they really do come in this order. It's important. The first is purpose. Knowing how the capital is going to be deployed is a great window in terms of what's going on with the company that's raising the capital in the first place. And it needs to be very clear how the money is going to be spent. And for that matter, is the money going to stay in the company? Is it going to be used to build the business? Or is this a financing where your money is flowing through the company and going outside the business, which in most cases, not always, but in most cases is a red flag. A company should be building its business if it's raising money from third-party investors in most cases. Give you an example of the distinction. In the working capital is typically short-term capital, typically less than 1 year in maturity, and it's financing short-term assets. And that's one basic dictum of debt, is the maturity of the debt should match the tenor of which the funds are being used. So typically working capital less than financing assets that are less than 1 year, accounts receivable, and inventory are the two that generally jump off the page. And so you would issue a shorter term security. Sometimes it'll go out to 2 years, but certainly, if it's an operating company that has some level of profitability, but it does have a need for indebtedness to manage its cash flow, you would expect those to match off. So another purpose, though, if it's a venture stage business which is not profitable, is is it being used to develop technology or develop the product? Is it being used to build a sales and marketing? It has a product, it has some early customers, but now it wants to scale, but it still hasn't achieved critical mass. So the purpose of the security, the purpose of the use of funds really needs to match where the issuer is in their development. And I'm actually going to speak to this slide. The second one really should be issuer. What kind of company is the issue? Is it established business? Is it an earlier stage business? Maybe even a startup? Because does that match? If it's a startup business, and it should be spending money doing the sort of things that a startup company needs to do to prove out a business concept. If it's an established business, whether it's running its normal business and needing working capital, or maybe it's going through some strategic event, it's building a plant, it's acquiring another company. All of these things provide a window into whether this sort of makes sense. And I guess one point I would make, even to those who are not corporate finance professionals, don't undervalue your common sense. I've been at this 35 years. I've learned a lot of things on the job doing that. There's no MBA that can possibly teach you everything you need to know about business. And trust your gut, trust your common sense. You might be surprised how often that's a good window into whether what you're being presented in a transaction, in an offering, holds up. But knowing who the issuer is, and when we talk about the issuer, it's what kind of corporate entity is to it. John, we talked about, is it a C corporation for incorporation purposes, or is it an LLC? That has an impact, obviously, on treatment or taxation of profits. But also, you need to reach into that. The company is the people. If there's one thing in any transaction that you just have to be rock solid, enthusiastic about, it's the people that you're investing in. We live in a very litigious world, but the reality is, if you find yourself in a situation where you have to rely on the law to protect your interests, and certainly going into it, you should be protected contractually. But if you get to that point, you're probably in trouble with the investment. So when we talk about the issuer, we're also saying, who are the senior management? Are these folks whose backgrounds make sense for the enterprise that you're being presented with? No disrespect to art history majors, but if you've got an art history major and they're building the next deep technology company that requires some very specific knowledge of microprocessors or things like that, or nanotechnology, there better be something in that art history major's background that suggests they prepared for the venture that they're launching, and they know how to deploy your capital intelligently. You don't want them to go through a learning curve on your watch. You also, with the issuer, should look through the issuer and figure out who owns this company already. You want to make sure that the employees have skin in the game. We talk about an equity culture with an issuer versus a cash culture. If you're an equity investor and the senior management isn't motivated, their compensation doesn't include a significant equity component in the enterprise, you're misaligned. If they're working for a cash bonus, but you're an equity investor, you may be in trouble. I mean, one industry which I had a brief experience with years ago was film. The challenge with the film industry is all of the parties involved in film are looking for a cash payout. They're not equity investors in the film per se. If you invest in equity in a film, there's a misalignment there. And it's one of those subtleties that's so critical. You've got to be aligned as an equity investor with the people that are going to deliver that value proposition to deliver the business. Now, the security. Fundamentally, what are you trying to achieve? Are you looking for current income? I would say in this environment, if you can generate a 12% current income, that starts to look like what you would hope to achieve on average, and it actually exceeds what I think many people are now projecting for the public equity markets as a return. So, that starts to look like a pretty attractive proposition where you can get to a double-digit return on a senior secured investment, and be happy with if you can generate that return over a period of time. But whether it's in an IRA or not, fundamentally, if you're looking for higher returns than that, you're going to be reaching into equity. Are they issuing you equity? If you're buying a note, you're not going to get a return any higher than the coupon, the interest rate that's indicated with it. Also, if you're looking for current income and you're buying equity in a venture stage business, that doesn't make sense. Also, if it's a company that's not generating positive operating income, i.e. they're a growing business that's raising capital to grow, you shouldn't be buying debt in that business because they don't have the ability to service it. The one caveat I would make is it's common in venture stage businesses on earlier rounds to buy a convertible note that's ultimately going to convert into equity. Just know that what you're really buying is equity. It may be called a convertible note, and contractually, if there's liquidation, you're in a better position, but you're in it for an equity play because typically those will convert automatically to equity. A bit of a nuance. Repayment. You know, it's odd after all these years I've been in the business, how often the simple question, how are you going to pay me back, isn't really right there up front on the table. If you're buying debt, you need to see operating cash flow. If you're buying debt, you also need to have multiple sources of repayment. So if you're secured, is it collateral that can be readily liquidated in foreclosure and you can get your money out that way? We represent it, as we'll talk in a bit about, we represent our investors after they invest contractually. And where we've had challenge transactions that have had to foreclose and liquidate the collateral, we have done the analysis up front and we've been able to sell the collateral. It's important that you do so and that you know that you've got multiple sources of repayment if it's a debt security. If it's equity, it's a bit trickier. There's really 4 ways you can get your money back from an equity investment. One would be the company sells itself, and that's probably the most predominant way that successful investments happen today in younger companies. Our economy, our system is by its nature supports a very rich merger and acquisition market. And if you're investing in a company that's built value, for example, if you were in the cosmetics business and you're investing in a early stage cosmetics business, well, those smaller companies are routinely sold to larger companies that grow their business through acquisition. And so we know going into it that if you can build your sales to $20 million, it means you've got a good footprint for a new brand, and you can probably find any number of larger companies would want to acquire you, and that would be one exit strategy. The initial public offering, taking the company public, is more and more challenging, and I won't get into the technicalities of why a company has to reach a certain scale to do a NASDAQ or New York Stock Exchange IPO. What I would say is keep your eye on a thing called Regulation A+, Reg A+. This was a part of the Jobs Act in 2012. And while it's not really made its way to full implementation in the financial markets, at least not it's being used, but it's not a really active part of the market. I do think there will be a time in the next 10 years, maybe in the next 5 years, where you'll begin to see a more vibrant public market for smaller issuers, and it's going to come out of Reg A+. But by and large, you shouldn't assume a company's going to go public. A third way that you can get paid back is the company's profitable enough that they do distributions, and you find your cash comes back through those distributions. And then a fourth way is a recapitalization, is the company actually is profitable, can raise debt, and they use that debt to repay equity holders. The point is, you know, some of the smartest investors I know first look at how they're going to get their money back before they start putting their money in. And I would suggest you do the same. Lastly, risks. There is risk in any transaction. Probably one of the classic examples of a blue chip that went down in flames quickly would have been Enron, which some of the people on this call would remember. Enron was a blue chip stock. And as I recall, once it started running into trouble for some largely financial accounting irregularities, it was bankrupt in a matter of, I think, less than 2 months. So was the accounting firm that supported that company. So there's risk in any security that you invest in. As I said at the beginning of this, the one thing you can do is diversify. Never take too big a position in any one deal. But you should be looking for a risk section in any offering document, and should feel like there is not just boilerplate discussion of, market risk or regulatory risk or what have you. Although regulatory risk for some companies is more acute than others, market risk, commodity risk is more acute for some companies than others. But are they giving you an insider? Really looking inside the company to say, if this doesn't go right, we could suffer if that doesn't go right, in specific terms. So again, if you cover all this ground, how are they using the money? Who's the issuer? Are they issuing an appropriate security? Is there a clear source of repayment? You know, is that being pursued, or do they have the capability in the sense of debt? And do you really understand the risks so that you can balance out whether the returns are commensurate with the risks you're taking? Well, then you've actually got a pretty good foundation for then doing due diligence and starting to test the disclosures that are made to you, and disclose and due diligence in essence, just to be clear, is nothing more than getting a bit of third-party validation for the representations that are made in the offering documents. And if there was ever you should trust the people that you're investing in, or you shouldn't invest in them in the first place, but you should also verify that what they're telling you. And if somebody takes offense, so an issuer takes offense at you asking questions and really challenging them, that's a red flag. Everything's on the table. There should be full disclosure. And sometimes you may have to sign a non-disclosure agreement to get to a level of information you need. But if you feel there's a hesitancy to really, you know, give you an open, comprehensive view of the company, then that's a concern. And then, in my experience, trust your gut and walk away. Okay, sorry, I hope I haven't gone on too long there. Quickly on Carofin, we've been doing this since 1996. We have raised actually about $1.2 billion at this point. It's a lot of small transactions. Our issuers have created over 10,000 jobs. We're fairly proud of that. Well over 200 transactions now. And actually, we're more than 20 professionals from Denver to Tampa, San Antonio, New York, and we are headquartered in North Carolina, but in this day and age, we really are pretty borderless. We do business from coast to coast. We have over the years. We are primarily domestic. Occasionally, we'll do an international transaction. And most of our transactions fall in sort of a $2 to $20 million range, though we've done considerably larger. What do we got next?
And then one thing I wanted to pause there for a moment, Bruce, is mention the 5 elements white paper that you were willing to provide to attendees. And so you can go to, and we have a link in the PowerPoint deck you see there, investments.carofin.com/get started. So you can go to that link right now and get a copy of these reports. I would also encourage folks to just go to the Carofin website, carofin.com. I had an opportunity over the last couple evenings really navigating through the Carofin website, and they have a ton of great information and education. I read some stories about a scrap metal business, for example, that Carofin was involved with. And so there's just a lot of good information that they provide real world application. So certainly check out their website, carofin.com. And you can get a download of the 5 elements report, which will dive a little bit deeper into what Bruce just talked about. And then, of course, you know, as far as the questions that you might have, let me go to this slide briefly. I know you probably have a list of questions, so make sure before we conclude the program that you send any questions that you have related to self-directed IRAs and potentially how to get started with a self-directed IRA to me, and we will make sure we respond promptly. And then any questions you have for Bruce and his team at Carofin related to the subject matter material, send that email to investorrelations@carofin.com. That being said, I will hand it back to you, Bruce, to close us out on this slide.
Okay. Yeah, just a little more. When you go to carofin.com, you'll see in the upper bar a link to the knowledge base. And within that, there's a library button you can hit, and that'll give you the full library of the white papers, the articles. There's quite a few videos, and these are all expressly written to be applicable to really any direct private investment that you might consider. And we certainly hope you find them useful. They only took about 25 years to write, so there's a fair amount of experience that's reflected in these, and essentially we're trying to create frameworks that take a very complex, or it can be a very complex and confusing process, and giving you some things to hold on to make it consistent and make sure that you can make the best decision for yourself. And again, it's not specific to our offerings. It would be to any direct private offering that you might encounter. What we offer, you could think of as sort of tracking the life cycle of a financing that's coming into the market. We conduct due diligence, and these guidelines are actually available to you. You can use them yourself or follow look at the same line items that we touch on. That is one of the articles actually in the knowledge base. But we conduct due diligence. The due diligence, of course, is tailored to the company in particular. As I said earlier, some may have more of a regulatory component. Some may have more commodity market exposure. Some may be more capital intensive. Are there key people that are associated with it? But I should also say, and as we conduct personal background checks on everyone that any key person in a company and their larger investors, we also do what are called liens and judgment searches. So if they have prior tax issues and things of that nature. So due diligence goes on and on. Again, trust your gut. Have a guideline to follow. Trust your gut along the way, and that'll go a long way, I think, in terms of you being fully informed. The offering documents should be complete, should be balanced, but diligence is that next step that, again, the issuer should be happy to help you with. They should have a Dropbox or something available to you. In our deals, our offerings, we do make those available to every investor. You simply click on a link in the offering document that's available online, and then you can go into our full diligence file. Continuous selection. We are always in the market with transactions. At any point in time, we're typically offering 10 or so offerings, and we've got quite a few that are in development. And again, we do that so that we can cover a broad range of investors, have a broad range of investment goals, and we can help them find an investment that matches what they're looking to do. It's, I guess, kind of like any retailing or like a grocery store. You know, if you go in looking for dessert, you're going to go to the dessert aisle, and that's what you're going to basically peruse. If you're going in there looking for beans, well, we can offer you some of that. So we've got the promissory notes, which again tend to be the lower risk part of the portfolio, and then a range of equity offerings. But having that selection and then applying some of the things we've talked about in this call allows you to begin to discern what really is best for you. This last one is not talked about very often within private investment, and it arguably can be one of the most challenging, and it's what we think is very, very important service that we offer for the transactions that we sponsor. We stick around, we stay engaged throughout the life cycle of the deal. If it's a debt offering, we are contractually established as an administrative agent. We process interest and principal payments. We monitor collateral coverage. And if for some reason the issuer is challenged, then we're going to become increasingly engaged to the point of foreclosing. So don't want to go there, but you have to be prepared to protect your interests. So if you've invested in the right team, typically in a challenge situation, you can come out with the best possible solution. If you've found yourself with someone who's dishonest or just doesn't have their investors' interests in mind, doesn't really treat you like a financial partner, then it's going to be a challenging process. But we do our best to make that call on the front end when we take on an issuer client, and then we stick around and we actually communicate with our investors on an ongoing basis about the performance of their investment, and we provide regular account statements so they know in more tangible terms how these deals are performing for them, how these investments are performing. So I think those three elements, while it's what we offered because we think it's essential that you do, that's how you look at this investment category. If you're investing and you don't have, it's not through us, you should be looking for the same thing. Particularly, I would say that, you know, doing your diligence, but knowing once you put your money in, frankly, in many cases, that's the easy part. It's getting your money back that, can be more adventure than you might have bargained for. So should be offset by the potential risks, should be offset by having diversity in your portfolio. So that's what we try to help people, make the most of this market opportunity and trying to mitigate risk every step of the way.
Fantastic. Appreciate it, Bruce. Can't thank you enough for coming into the virtual classroom today and being willing to share all this information, education. As everyone can tell, Bruce and his firm, they have a vast, I'll say, database of knowledge and experience and education that you can tap into at carofin.com, as well as reaching out to them directly, which I'd encourage folks that are interested in pursuing these types of avenues. You can email investorrelations@carofin.com. As said before, with your questions, any self-directed IRA questions, feel free to direct those to me, and we'll make sure to respond to you promptly. Again, Bruce and the Carofin team, I can't thank you enough for coming on today. I know that we will likely have more training and more education. I know that you have additional training and education on your website as well as we do on YouTube and other avenues. So for everyone out there that is looking to take advantage of compounding interest in the absence of taxation, as I call it, with a self-directed IRA, 401k, or other tax advantage investment account, investing in direct private investments, I would encourage you to keep pursuing those avenues and opportunities, which enable you to generate interest income, which of course is always tax exempt in the tax exempt IRA, Roth IRA, or other self-directed investment account. So that being said, again, Bruce and the Carofin team, thank you so much for joining us today. And for all of our viewers out there, thank you for joining us on today's program. We look forward to seeing you in the next virtual class.
John, thanks to you and your colleagues. Really appreciate the opportunity.
Thank you.
All righty. All the best.
So long, everybody.
We are a FINRA registered broker-dealer. FINRA stands for Financial Industry Regulatory Authority. Our world is contracting as well. And if you were to go back about 20 years ago, there were about 8,000 broker-dealers. Today, there's about 3,500. And a number of things that contribute to that: normal consolidation of an industry, but regulatory load has also increased significantly. What I think is important to note is your average broker dealer. Well, first of all, you've got to be a broker dealer to sell securities in this country to a third party, as we do. But there's a wide variety of broker dealers. In our case, we're sort of a throwback. We are actually bankers. The word would be corporate finance. So our expertise is evaluating a corporation. And then we really go through a design process where the circumstances of that issuer, the common theme is they need capital, but the question is, what type of capital? How should they raise that money? Should they issue debt or equity? And we'll talk about those in a bit. But we evaluate that company on the front end. We design a security that's both appropriate for the circumstances of the issuer and that we think offers a fair return to the investor. And we do that under the auspices of FINRA. It's a highly regulated industry. And you should know that we are under a microscope. The information we receive from investors must be held in confidence. That's a regulation that has criminal ramifications if it's not honored. So our overall market is discrete, it's private, but even within that, any individual interactions we have with investors or issuers are treated with a high level of discretion and are kept confidential. So, and all of this falls under the U.S. securities laws.